Lots of cash flow problems. 28, Target Stores has just received a $4.8 million offer to buy a parcel of land that Target once planned to build a department store on. The land was originally purchased for $2 million, and Target spent an additional $9,000 clearing the land at that time. However, Target has now decided to use this site to build a distribution center. To build the facility requires a capital expenditure of $12 million. What is the proper initial cash flow to use when evaluating this project? No, you never use a sunk cost. This is a sunk cost, so you don't care about that. What do you care about? You care about any new cash flows. So you have an offer to buy the land at $4.8 million. That's the new cost to the purchaser. Plus they told you that you need $12 million in working capital or capital expenditures. So those added together are $16.8 million. 30. Bond yields observed in the market indicate the nominal rates of return demanded by investors. That's your yield to maturity. In addition to a real rate of return, which of the following concepts are included in bond yields for corporate bonds? All of these. So it's your inflation risk premium, your default risk premium, your lack of liquidity premium, and your maturity premium. Now that's versus the Fisher concept, which is your real return plus inflation. So initially, Fisher was some PhD in an ivory tower somewhere, which never works in terms of reality, that said that this is, you only got compensated on a bond for your real rate of return, for not consuming, plus inflation. But they came back and said it's all of the above. You get compensated not only for inflation, default, lack of premium, and maturity premium. Here's a long cash flow problem. 32, 33, 34. Using the following information, Harley-Davidson, by the way, their symbol is HOG, if you didn't know that, is considering a special edition motorcycle called...
Do you know what it stands for?
What?
HOG?
No.
Harley's Owners Group.
No, I didn't know that. Thank you. It was a good stock for me in Chicago. We owned a lot of it. A special assembly line will require $9,000 capital investment. At the end of the 3-year product life, Harley can salvage or sell the assembly for, that's $800. Sales are expected to be $10,500 per year for a 3-year period, with expenses excluding depreciation of $4,200. The company would also have to commit initial working capital to the project of $600 at time zero. The company has a 34% tax rate, and the assembly line can be depreciated on a straight line basis for 3 years. What's your initial cash flow? That's question 32. That's the $9,000 initial investment, plus always your working capital. And both of those are negative, right? Because they're outflows. So that's negative, and that's negative. 33, project cash flow is the same for years 1 and 3, right? Because you're not getting rid of it until year 3. So I need to figure out what my depreciation is. So they said that you have $9,000 divided by 3. So my depreciation is $3,000 a year. So what's my operating cash flow? That's my $10,500 in sales minus my expenses minus my depreciation. That gives me $3,300. That's my earnings before tax. So my tax at 34% is $1,122. Add back my depreciation, which should be $3,000, right? Yeah, $3,000. That will give you $5,178. You guys remember doing that? Yeah? No? Speak to me. Do you want me to go into more detail?
Yes, please.
You want me to go into more detail? So remember, you have to calculate your depreciation somewhere. You've got to take that depreciation out, right? To figure out what your tax bill is. And so this, less this, would be your net income. Type in subtotal. So I've got to take out my taxes that I have to pay, but I have to add back my depreciation. So this is my operating cash flow for years 1 through 3. But because you're selling this project in the 3rd year, you're going to add this to your terminating cash flow. So the next step is figuring out that terminating cash flow. So how much are we selling this for? We're selling it for $800. It says right there. We've depreciated it down to 0. So my gain is $800. So I've got to take that $800, multiply it by my 34% tax rate. That's my tax bill of $272. Don't forget to add back your working capital. There's my $600. This is right. 800, 272 negative, because you're paying taxes on that. 600 is my adding back my working capital plus your operating cash flow of $5,078. So that's your total cash flow. Now, if you were asked to figure out your net present value on that, you'd have your initial, right? Which they could. Then you'd have cash flow. This is where your operating cash flow would be. And this is where 3, that would be your ops plus your terminating cash flow. And that's number 34. If you don't remember how to do this, I would go back and spend time with it. I have several other problems as examples that I'm not going to have. I have them written out, but I'm not going to be able to go through all of them.
How many problems do you think this will be on the exam?
Operating cash flow?
Well, the full cash flow.
I bet they have one like this because there are several of these in sample A and B, like 4 of them, like 2 per test. So I would look for 2 complete problems. Some of them ask you to figure out the NPV, some of them don't.